For much of the last decade, homeowners and home buyers have been warned. Interest rates are going up. Well, it seems no one consulted the bond market. Consider how your mortgage rate is set. A bank borrows money on the bond market so it can loan it to you. So as bonds fall, the cost of a typical fixed-rate mortgage falls too. Good news. But the bad news is the bond market is being pushed down by deep concerns around the world. China's GDP is slowing. The U.S. economy grew at just 1.5% last quarter. Canada's economy actually shrank at the end of last year. So you're paying less to finance that house or condo because the bond market believes the global economy may be about to get worse, not better.
It can mean a lower payment for households, but we also want to see the Canadian economy doing as well as possible.
The bond market is far larger and far more powerful than the stock market. And right now, it's behaving in a way that's setting off alarm bells. If you loan on the short term, 3 months, say, that usually yields less reward than a longer loan of, say, 10 years. That's the so-called yield curve. And last week, it flipped. An inverted yield curve has long been seen as a harbinger of a recession. The last time that happened was 2007. Months later, the world plunged into the depths of the financial crisis.
The signal, especially in the U.S., has been very reliable. The yield curve slowing down is a clear signal that the economy is slowing down.
So, where does that leave us? The bond market's saying the economy will slow, wages won't rise, and just maybe a global recession is looming. But at least your mortgage payment won't go up, right? Peter Armstrong, CBC News, Toronto.